Thanks, Simon. I've actually got a ton of stuff to give people, and they're going to need a pen and paper to note down a couple of URLs, because I've created a little depository for them online of PDF slides, infograms, business plans, the latest data from a couple of the big banks and what they're telling their wealthiest clients. So for those interested in stocks in the long term, I've got something for you. Those interested in what's happening minute by minute on Forex and what we're doing in our fund, I'm going to show you that as well. So short-term, long-term, Forex, all the rest of it. Let's get on with it. And I say, because there's so much information, what I'm going to do is give you a link so you can download all of this stuff as well. I just want to make sure that you can see the screen, which you should be able to. I want to make sure I can see the screen as well.
I am looking at the S&P 500 annual return. If we could use the chat box, maybe somebody at home can just confirm they're also hearing and say, "Oh, great, yes, great." Right. So we're all systems go, Alpesh. Over to you.
Good. Sorry about that extra belt and braces caution, but I have ended up talking for half an hour only to realize that nobody could see a thing. Look, where are we? Let's start off with stocks. Let's start off with the slightly longer term. Then we're going to move right to where the money's being made, and more importantly, strategies you can adopt, how much you should expect to make, in what time frame, and most importantly, what's the risk associated with each return. Okay, and we want lots of new material that I want to show you and share with you as well on this. Well, where are we on the S&P 500 annual returns? You can sort of see on this screen the red dots are the maximum declines in any given year, and the blue is the actual annual return. Actually, whilst it feels like an amazingly exceptional year, it isn't, either in terms of declines or rises. But what does that mean for us in terms of the risk we might be taking in terms of stock? Should we shift more to the short term? Should we shift to Forex? If we are still looking at stocks, how long are they going to last? What the heck should we get into? Like I said, everything that I'm going to tell you on this webinar, and about 10 hours worth more, is freely available from that link. So I want to bribe you all first just to like me. Okay, if you go to that link, and you don't have to put in an email address or anything, it's just a free link. You're going to be able to download the PDFs of everything that I'm showing you as well, because I don't want people to think, oh my God, I didn't make a note of that, I missed that slide, and so on and so forth. And I'll come back to this, but again, I created this especially for you, Simon, and literally just uploaded the last PDF in about the last, I don't know, a few seconds ago. It's going to look like this on your screen. So there's quite a lot of material for you guys. So there's the bribe first and foremost. I don't want anybody to worry that they've missed anything. When I come to trading on this webinar, the things that I'm going to be actually talking about, they stem from, what, 20-odd years since I left practice as a barrister to trade full-time. My first book came out, Simon, as you know, because we've known each other this period of time, called The Mind of a Trader. Don't buy the book. I'm going to give you the best bits in this webinar from it. It's a 20-year-old book anyway, and I only get £1 in royalties from the Financial Times, so it's not worth it. Bill Lipschutz became my mentor, global head of foreign exchange at Salomon Brothers. I met him through the book, and then we got to know each other. He helped me set up my hedge fund, which was 10 years ago. Well, 2004 is when we launched it. His boss was Warren Buffett at the time. So I've got some very helpful people along the way. When I pick mentors, I want them to be the world's best at what they do, and that was certainly the case with Bill. By the way, in 2016, he was the voted Hedge Fund Manager of the Year, so I'm delighted to have a mentor like him. I'm going to give you everything he's taught me in this webinar, okay? Plus everything that the best bits of what I've published in my various Financial Times books. I launched my fund 10 years ago, or my funds now, for the same reason you're all trading. You want freedom, you want fulfillment, okay? And making money is the extra bit. Actually, in my experience, most people, if we're just making an extra 500 to 1,000 a month, we're more than happy. It's not everybody wants to be billionaires, okay? So we're going to focus on realistic sums, where people are starting off with, say, $3,000 in their bank account of risk capital, and how can they realistically look to make, say, 500 to 1,000 a month, and what risk? Because obviously the more you want to make, the greater the risk you're taking, and the more likely you're going to blow up. So how do we mitigate those risks? This diagram is from Bank of America Merrill Lynch, and it shows every different asset class and their total returns since 2000. All right, so since after we've known each other, Simon, it's a hell of a long time. And it's one of the reasons why I don't like trying to pick asset classes or just saying, oh, I'm just going to be in stocks or just in Forex or whatever else, because there is no pattern to this quilt. Okay, there is no pattern to, and let me zoom in for you guys, because you know, you'll see some years it's commodities, other years it's S&P, and S&P's had a good run. Is it going to continue next year, and so on? You know, your best bet ends up becoming a guess, and I don't like guessing because that's too much risk if we're guessing. Okay, so what I want to do instead is give you specifics from the bottom up. I'm not just going to say top down and say, oh yes, well, I think it's time for emerging markets or whatever else. Okay, when it comes to the kind of specific trades, well, before I tell you what we're looking at, let me show you what some of the big banks are telling their wealthiest clients. This is what Morgan Stanley is saying are their top trades. Now, most of you are not going to be looking to do some of these very complicated things, but I thought it was a nice thing to share and show you in case some of it does indeed tie up with your own thoughts. Now you can see buy S&P 500. That's their top trade. They're telling their wealthiest clients. Some of these things will make no sense whatsoever for most regular retail clients. And why should? I mean, we don't trade US Treasuries and bunts either. Okay, we don't do what the heck M Bono is. But then again, there's some of these top trades which will make sense to you. The reason I wanted to share that information with you is because it's important you don't just hear from me, but you also hear from a whole mosaic of information and data that we've got to hand. I'm going to show you some of the live trades we've got going on at the moment. I'm also going to rate some of the stocks that we've got too. Okay, let me move on to what Bank of America Merrill Lynch is telling their private clients in terms of flows and allocations, i.e. where's the money going? It's certainly coming out of energy and utilities. Now, whatever reason that is, that it's coming out of these or going into others, I'm not going to sit here and tell you some kind of half-baked theory to fit the facts. We, in everything we do, look for momentum, look for direction. What we don't do is try and come up with theories after the event and say, oh yes, absolutely, we should be looking to get into energy because I've got some compelling story around it. What we've found, and I used to lecture at Oxford University on behavioral finance, is the psychology aspect really messes up people. What they end up doing is they spend hours and hours coming up with theories or interesting stories, and then they invest on the back of those stories, which have no credence whatsoever beyond the fact that they seem to fit historic fact, and then they mess up. Okay, so whilst I'm telling you where the money's going, I'm not going to tell you why I think it might be going into those areas. Instead, what I want to tell you is where we're putting it, based partly on what we're seeing around us, but also based on our hard data. Okay, again, I just want to continue a bit more with what Morgan Stanley is saying to people, or what the big banks, I mean, they're indicative of all the major big banks at the moment. And on that Google Drive link that I gave you earlier, I've also got Goldman Sachs's top trades. There's a PDF on there of what Goldman Sachs is saying is going to happen in case people think, you know, one investment bank's better than another. These are the price targets for the S&P, okay? And these are the sectors they're overweight in, neutral, and underweight. Now, still, this isn't telling us, okay, well, what the hell should I do, Alpesh? This is just giving us a flavor of some background which sort of muddles around in our head, right? But I wanted to give you this context before I tell you exactly what we're doing, right? Similarly, Morgan Stanley is saying, and this is where we're getting a bit closer to what's actually happening in the market. We are not going to have a crash this year, famous last words. We might have one next year, but I'm going to worry about that when that happens next year, or when we get into next year. What I'm saying is, at the moment, what the big banks are still saying to their clients is pour your money into equities. Okay, they are seeing valuations get to a toppy level, yeah, but more importantly, they're still saying, and this was as of August the 4th, so only 3 weeks away, they're still 3 weeks ago, they're still saying we have got a fundamental case or a theoretical case for still going into equities. Okay, in another way, put another way, this is where they believe they are. This is from Merrill Lynch, where they believe they are. I'm going to come to short-term trading and equities in a minute, and Forex in a minute, but this is where they think they are. Now, before I move to short-term trading and Forex, let me tell you what I like. Okay, these are from the FTSE 350, the highest ranked stocks for a 12-month period as of today. And what we do here is we data mine the fundamental data on these equities. Okay, now I've given you a context of why I'm not worried about being in equities, because I've explained to you that, yes, whilst we're coming near the end of a top, we're still not on the downturn. So I think there's still mileage to be had. If there's mileage to be had, I want to mitigate my risks. If I'm mitigating my risks, then these are the highest ranking ones I'm seeing at the moment. You can see the 9s. Okay, you can see some of the 8s. I don't like 8s. I only like 9s. I sound like Donald Trump, don't I? That's the FTSE 350. Let me show you with the US. I told you you're going to possibly need a pen and paper. What's happening on that? Now, the question arises, well, wait a minute. What does this mean? How did you come to them? Are they any good? What we do is we look at which stocks are relatively undervalued by looking at their fundamental data, because we've researched, and when I did this when I was writing my weekly column in the Financial Times, The Diary of an Internet Trader, because obviously when you're placing trades and you're reaching out to an audience of 1 million, as it was back then with the Financial Times, you've got to make sure that your research is solidly grounded. Now, I was writing those 200-odd columns over 5 years. What the research showed was that when it comes to valuation, when it comes to growth, when it comes to income generation, there are certain criteria which are relevant and some which aren't. And most importantly, you've got to know what to weigh, and that's what the skill is. It's in doing all of that. So when we look at 12-month holdings, and this is all for 12-month holdings, what we did is we looked at what factors were relevant. In our case, we looked at, for instance, everything from price earnings growth to price earnings ratios to year-on-year revenue growth, dividend yields, and then more importantly, we had to weigh it. Then after weighing it, we scored it. So it could come to a simple score out of 10. Why? Well, because the human brain is fairly simple, okay? So when we did that, this is the numbers. These are the numbers that we came up with. Now, for those interested in the Dow, this is how the Dow stacks up. Johnson & Johnson, United Health, right at the top for Dow stocks. Those interested in NASDAQ, the NASDAQ 100, the 100 largest, these are the top 4. Now, you might say to me, oh, why do you like Sirius XM radio? Well, we data mined the fundamentals and we used it based on. Now, remember, this is for 12-month holdings. If you want to know what that means, since we started doing this in 2004 with stocks for 12-month holdings and rating them, £10,000 has become $250,000. How does it do that? Well, there's the chart. Let me zoom in on that so you can see it. Using this methodology, because you might say, well, wait a minute, why should I use your methodology? And why should I trust any of these names you've given? I don't actually mind whether or not you like these equities. I just want to give you a flavor. If they coincide with the ones you already like, hey, great news. But just to say, it's a system with a pedigree, okay? Looking at fundamentals, valuation, growth, income, and then weighing each of those. Now, I'm not going to sit here and show you how to reverse engineer it. What I am going to tell you is these are the ones at the moment for a 12-month period that we particularly like, and we would look to target unleveraged about 20 to 25% per annum over a 12-month period, unleveraged. If you leverage that 2-to-1 with a CFD broker, okay, then you double that return, obviously. Okay, you also double your risk. That in any given year, you won't make that return. All of this is in that Google Drive, which I'll give you the address later as well, all this information, because I know it's a hell of a lot of information to take in. But what I want you to take from this is not just the names that I'm giving you here. What I also want you to take away from this is the methodology. We've got a methodology which we've been using since we created the fund, okay, or the funds now. Actually, we've got 4 or 5 of them now running. Well, actually 5 as of this week, a 5th one. And what this methodological approach, because it all comes down to approaches. Nobody wants to be a screen slave sitting in front of a blasted screen all day long or running to their phone every time there's a beep beep alert. We need to be efficient because everybody's got better things to do, especially if they're only looking to make, say, 500 to 1,000 a month. Then they've got other things to do. If they've got other things to do, they need an efficient system. And an efficient process for us was using computing power to narrow it down in terms of names. Okay, so I want you to appreciate that methodology, that whatever methodology you use, try and find out which criteria you think are relevant and then weigh them and then come to some kind of scoring system. Do that rapidly. Okay, I'm going to come back to this for shorter term trading in a second, but for longer term, these are the names that we particularly like. And I can come back to any of this a little bit later on as well. Okay, now some of the many other things that I've got to cover in this, I'm going to show you some of the shorter term trades that we're doing in foreign exchange and the kind of returns we'd be expecting. Now, when it comes to shorter term trades, we, like many hedge funds, are trend following, which is a great time for us because last year trend following hedge funds were the best performing in the world and using computers. Okay, more and more, you know, we use computers, and so I'm going to show you a bit of how we use computers, but actually all you care about is, well, that's great, Alpesh, how does this make us money? So I'll give you the trades that we're doing at the moment and how we do it, which will hopefully help inform your own strategies, your own processes, so you become more efficient, you're not screen slaves, you can get those returns and mitigate your risks by having a process which I, as a private investor, 20 odd years ago when I was leaving university, leaving the bar, thinking, okay, if I should do this for the rest of my life, then I better learn from the best and I better learn a methodology so that it's not more risky than just being a lawyer who are fat cats and overpaid and get paid money for doing next to nothing. So for that reason, I want to impart some of that methodology to you. This is probably my most successful ever student or employee. She's actually used to work for me straight out of university at the age of 21. She left UCL. She now manages $10 billion for Newton Asset Management. She left my company, Profinium, to go work for them. So the reason I'm giving you some of this historic background is because otherwise you're going to think, well, it's just some bloke off the internet, isn't it? And we know everything on the internet's fake. So we need to know, okay, who can we trust, who can't we? And for that reason, you need credentials. This is what our latest fund looks like. We're doing a Dragon's Den this year. We've got $1 million allocated into 10 groups of $100,000 each. And this is an aside. If any of you are out there who can give us information over the last 12 months of your performances, and we're particularly, and if you don't know what these terms mean, don't worry about it, the internet, you can look them up. We're particularly interested in your Sharpe and Sortino ratios, and we're interested in, if you don't know what these terms mean, like I said, look them up, skewness and kurtosis. Okay, because we're looking to Dragon's Den, seed, fund, other traders. Why? Well, you've all heard of crowdfunding, you've all seen that there's a lot of talent out there, and it seems to make a lot of sense for us to do it. That's how we've been performing on one of our quantitative funds, which is 10 algorithms all put together, and this is the aggregate performance of all of those. So we trade off the back of those. This is what the distribution of return should look like for you as a private investor or for us as a fund. Okay, so for our quant fund, which is purely quantitative, okay, which means that we look at, well, I'll show you what we look at. We look at a lot of the price data. We're not going around meeting companies. We're not sitting there trying to theorize the world. We're simply looking for price movements and using computing power to do it. This is what, for hedge funds, monthly returns look like. They are skewed in positive terms at this end, and there should be very few losing months. And any months which are losing should be very small in size as well. Okay, so how do we get that kind of an output for you guys? How do we professionalize what you're doing so you're not just randomly, oh, I'll do a bit of this, or I'll read a bit of Investors Chronicle, a bit of Shares Magazine, or I'll just follow what XYZ said, I'll do that. So you're not just haphazard and just going from one pillar to post. Okay, this, by the way, is the breakdown of the quantitative fund with all 10 algos put into it. Okay, and we think this is the way people are going to be trading. So I'm going to show you what we are trading at the moment and what we like across the board for retail clients, okay, for private investors. So private investors can do it. What we like for private investors are these figures. We want them sitting in front of a screen only for about 15 minutes a day, before and after work, scanning about 12 to 22 individual currencies, I'll show you what I mean, on one screen, and probably placing one quality trade a day, which equals 20 trades a month. What we found is when people do more than that, they become screen slaves, their return on time invested drops, and they do lower quality trades. When they do fewer than that, they're not making enough money, okay? And it's getting that balance right. Now, this is based on years and years of experience of knowing that actually this approach to it works. Let me show you from a retail perspective what we look like at the moment, what we like and what we're looking at and what we're trading right at the moment. Okay, so this is the shorter term end. What I want people to do is look at 12 to 16 or 22 little windows. You can see which currencies, equities, we're looking at the moment, when it comes to your methodology, what you need to do, let's just look at euro dollar for a second. You've got to get a methodology which allows you to give you your entry, down arrow means to sell, gives you, that is not a profit target. Now, this is really important. Anybody who tells you about profit targets, they're Muppets. Okay? All the successful hedge fund managers in the world, plus I've written 18 books on trading. I love writing. And Barclays launched my latest book, which was 10 years. It took 10 years to write because we got a whole load of data, because I love everything to do with data. We got a whole load of data from a bunch of brokers to see what the 10% of their clients who actually make money were doing right. Okay, and what the 90% were doing wrong, and see how they correlated to the professional investment market, us in the hedge fund industry. And what we discovered is that 10% were doing by accident. They didn't realize it. They weren't trained as, they weren't ex-fund managers. They were doing exactly what profitable funds do, which is that instead of having profit targets and this bullshit about, oh, you have 2-to-1 reward to risk ratio, why would you want to cap your profits ever? Why do you want to cap your profits? Okay, what the successful ones do is they add to their winners. Now write this down, that pen and paper I told you to grab, write this down. Winners add to winners. So what you see there as a dotted line, I'll tell you how you can you develop the strategy so you have this mindset, you have this mentality, you have this process. What they do is at that point, they'll double up their position or they'll increase it by 50% if they want to pyramid in, doesn't matter. They add to their winners. Now I'll tell you why. If you strike gold or you strike oil, you don't just sit there and go, oh great, let's put a cap on it. That's it. Let's go look for a drill somewhere else. No. On those few occasions, and God knows they're too few in the market generally anyway, you need to find those trends, and when you do, you double down on them. But there's another advantage to that approach, where when you hit a certain level of profit, the advantage is this. It allows you to start with a small trade size in case it goes to your stop loss, which is this yellow line here. How did we come to that? And how did we come to this add position here? I'll tell you in a second. Okay, so you need to have your entry, right, which is dependent on your own methodologies. Now, one thing which doesn't work for sure is all these technical indicators. They used to work in the 1990s, okay, and then everybody else taught them. So forget Fibonacci and Elliott. That's just your brain playing tricks. Okay, everything works to some small extent. Nothing works completely. So what we do when we look for entries is we look at multiple indicators across multiple time frames, and then we filter and filter and filter until we think we've got something which is a very high probability, because we have a multitude of indicators across a multitude of time frames telling us that the direction is more likely than not to be in one direction. Even then, we don't have a crystal ball. We're still playing the odds. Now, I want you to think this. Okay, a coin is right 50-50. God is right 100% of the time. We're only trying to be right maybe 6 times out of 10. In actual fact, people like Bill Lipschutz were only right 4 times out of 10, but they were hugely profitable. He was the largest Forex trader in the world. Like I said, I was privileged. He was my mentor and taught me how to set up the fund. And strategies, the thing is, the reason they were able to be profitable, even though they were only right 4 times out of 10, is because the 4 times they were right, they made more money than the 6 times they were wrong. They were more than happy to take small losses, get the hell out of there, preserve their capital, move to the next trade, looking for this trend, and then add to their winners. So when they added to their winners, they made more on those 4 occasions they found the trends. Now you might say, oh, but Alpesh, if they just held on and on and on forever, they could have had more winning trades. It's not about the number of winning trades. It is not about your ego. It is about profits and money. Okay, if you're interested in ego and how often you're right, and there's Muppets out there telling you they're right 90% of the time, fine, time to come work for me. I'll give them $1 million to trade with. They never turn up because their egos always let them down, because they're never right 90% of the time. Nobody has a crystal ball, not even George Soros. So what we try and do is we use a bit of simple maths to put the odds in our favor. We start with a small position size. We add to the winner, because then we're only risking profits. And how do we find the stop loss? Well, the stop loss can either be due to your experience. It can be volatility based, because the more volatile the market, the further away the stop loss. Write that down. Volatility based stop loss. The more volatile the market, further away the stop loss. Now, people get fixated on that. They say, oh, how many decimal places should it be to? Guys, I told you, you're either going to be right, hopefully more often than a coin, but not as often as God. So you're only playing for 6 or 7 times out of 10 right. So 1 decimal place here or there is not going to make much of a difference. Okay, oh, so you only made £500 in a month instead of 501. So what? Get on with the trading, get on with the doing, not the trying to perfect. Trading is an entrepreneurial venture. Entrepreneurs will tell you they get out there with minimum viable product. They don't get out there till everything's perfect. So we don't look for holy grails. We get out there and trade the bloody things. Okay, so we happen to put that on based on volatility. The amount we'll trade will therefore be smaller the further away the stop loss, so we don't lose more money just because the market's more volatile and therefore the stop loss is further away. All of this again is on that PDF in that Google Drive, which I'll come back to. It's just there's a lot of information. It's really important. I want to compress 20 years worth of Diary of an Internet Trader columns and my books into this webinar. Okay, and that level is just a mirror reflection of the stop loss, where we're going to add to our winning position. We're going to use trailing stop losses if we're not going to be at our desk, okay, so that we can just let the market take us out, preferably at ever-increasing profits. Now, as you can imagine, there's slight nuances to all of this, but those are the fundamental principles of every successful hedge fund in the world. I'll say it again. Winners add to winners, losers add to losers, never add to a losing position. Volatility-based stop losses, and then volatility-based money management. Okay? Now, let me go through some of the other positions. We love Australian dollar, US dollar. Why? We don't care. I know nothing about the fundamentals of the Australian economic system. And don't get me wrong, I've got a master's in economics, but it's irrelevant to the task at hand when it comes to making money from trading. We are looking for our multiple indicators across multiple time frames to show us that there's likely to be momentum, i.e. trend following, and then we're following those trades. You can see the down arrow here. At the moment, we are short Australian dollar, US dollar. You might say to me, aha, Alpesh, look, you haven't made much, have you, in a couple of weeks? Fine, doesn't matter. We've got multitudes of positions. We're not in the business of trying to be 100% right, getting in right at the top or getting out right at the bottom. That's BS. In the real world of trading, that doesn't happen. You make your money, you move on. Our other key positions I want to go through, sterling, Japanese yen. The trends are getting nice and smooth again. Most people have noticed August has been a bit of an awkward, difficult month. By the way, Facebook, because it's in the news, so I wanted to discuss it with you. Since 11th of July, we've had this long position in it, and it's still there. It seems to be fizzling out a bit, but we're not out of it yet. So for those people worried about tech stocks and so on, I just want to let you know. Now, Visa, for anybody who's been following me for years since my Bloomberg show and my stuff on BBC, you'll know I've been banging on about Visa since they IPO'd back in, I think it was about 2008. Okay, it's been a one-way bet all the way along. We're long on this from the short term since, pretty much since my birthday in middle of July, okay? And it's been wonderful. It's been absolutely wonderful. For those interested in the FTSE, our indications are we're still long. Okay, we've got a multitude of indicators telling us across multitude of time frames to be long. All right, and we've doubled down on this position because we had the upward move there. All right, now cable's very much in the news, and I can come back to any of these, but I just want people to know. And whilst it had been diving for ages, we've got an upward move now. Now, this has got nothing to do with me saying to you, oh, let's gamble around confidential news like interest rates and unemployment announcements. We don't gamble before a piece of news. Okay, if you want to do that, go to Ladbrokes. We look for the trends in place already by looking at a multitude of indicators across multiple time frames, then having our computer systems do that for us. Okay, and that's one of our 10 quantitative models. Okay, it's just one of the 10 algos that we use. Obviously, you'd expect us to use algos. Everybody's using algos. All right, saves a hell of a lot of time, and computing power has made all of that possible. Now, I can come back to that in a short time if you want me to, but these are the rules I give for private investors. I say, look, I don't want you spending too much time in front of the screen because you're going to get a poor return on time invested. Scan 12 to 22 products. In one sense, it almost doesn't matter. When you're more sophisticated, what you're actually trying to do, and for the more sophisticated ones of you, listen up to this, what you're trying to do on euro dollar, for instance, for argument's sake, is to go long euros on the 30-minute time frame and long dollars, let's say, on the 30-minute time frame, and short dollars on the longer time frame. Hence, you're hedged in dollars across two different time frames and two different currency pairs. In an ideal world, you're making money in every single time frame. Okay, but don't worry about that. That's more complicated than you need it to be, but I just want to show you what some of the bigger picture is. And by the way, you can use, there's a whole bunch of retail brokers. The reason I'm showing you retail brokers is because you're retail clients. It makes sense just to use regular brokers. Speaking of which, let's turn a bit more to these trades and brokers as well. Okay, most of you will have seen data like this, which are currency pairs and the percentage of winning and the percentage of losing trades. Actually, the surprising fact is that private investors are right more than 50% of the time. The problem is, even though they're right more than 50% of the time on virtually every major currency pair, they still manage to lose money. You know why? Because losers add to losers. They add to their losing positions. They don't add to their winning positions. So part of what I'm teaching you in terms of tactics is making sure that we skew it the way I explained. Start off with a small position, add to your winners, set your stop loss based on volatility, and make sure that way round your position sizing is dependent upon how far away your stop loss is. All of these little tactics, those are the ones that Bill Lipschutz taught me, and he learned off other people. I mean, what I'm telling you isn't actually rocket science, or it's not like I've discovered, I'm not going to win a Nobel Prize in economics, let me put it that way, okay? I'm just copying what worked for others, which is what 99% of people who are successful at something do, okay? It's only 1% who are Steve Jobs. The reason most people don't make money, if there's one diagram I could show you, is this. This is, in one sense, what they do. They like to get their win, so they take small profits, and then they never tell me about this bit. That's why we've got this Dragon's Den competition, where we want to allocate to a group of people. And we've already made one allocation. There's 9 spaces left who can, you know, show us the kinds of metrics we're looking for. So we can see, yeah, actually, these guys, they get it. They are balancing their risks correctly. Okay, by the way, everything I tell you is based on me, first and foremost, being a trader, or what Channel 4 called the UK's best known trader. So I want you to know, when I say just get on with doing it, that's what traders do. They're not sitting there in front of a screen theorizing about Elliots and Fibonacci's and volumes and all the rest of it. Our offices, this is for institutional investors only, so pension funds, high net worths, sovereign wealth funds, family offices. We're based out of Mayfair. Our funds are domiciled in Luxembourg, okay? Rothschilds are the bankers, auditors are Ernst & Young, legal advisor Allen & Overy, and pension funds are our main investors. So you can imagine we have a great focus on risk management, all right? When it comes to picking brokers, I created this score sheet for you because what I realized, it's one thing for me to tell you strategy is what we're looking at, what we like, what we don't like, and so on. But that still led to a lot of people messing things up because they got the wrong brokers. So I have a very simple score sheet. You might want to take a picture of this or write it down. Any score below 50, avoid the broker. All right, if you can't add these totals up, avoid the broker. There's only one broker I've ever approved as one that I use, which is based outside of UK, US, or Australia. There's only one. And the reason I approved them is because I had to go meet their CEO in order to get my scores up. I went to their offices. I used them for 10 trades satisfactorily, never binary trades, okay, never binary options, because that's a con trick. Withdrew money from them, make sure they weren't ripping anybody off, met the staff in person, and then I told them, listen, I reached 75 million people on the BBC. Don't mess around with me or the people I send you to. So yeah, that's an unfair advantage I have. You're going to use every bloody advantage you can get your hands on, because brokers, I don't trust any of them. Now, let me say that again. I don't trust any broker on the planet. Brokers are like lawyers, plumbers. I apologize if there's any plumbers and lawyers here. My point being that I'll score them and I'll watch them like a hawk. And this is the scoring sheet I created for private investors to use. Okay, so use that sheet when you're looking at brokers, all right? Whichever ones you're looking at. The other thing, which is really important for you guys to, and this isn't a recommendation of these particular ones, is all brokers mimic the interbank rates, okay? They all mimic. And now you might say, well, why are you talking about Forex? Why don't you just keep talking about stocks? I don't care where money is made. I don't care whether it's made from the lottery. If I could hack that, I would. I don't care whether it's made from stocks or Forex. And neither does the man charging me £5 for a Starbucks. It doesn't care where I earn my money either. Okay, the reason I like Forex is because the inherent costs are lower. And the reason I like private investors using Forex is because the inherent costs, for instance, this kind of software is all free. You'll have come across it, it's MT4. you won't, don't trade on MT4. It's awful to trade on. Just use it for the visual data. Use it for the free live quotes visual data. Got it? Use it for that. One thing I want to get across to you all is the spread difference between brokers, as you all know, varies. But what you'll notice is that they all mimic each other. They mimic each other because they all take the price feed off the interbank rates. And there are certain times, for instance, when London closes and New York opens and so on and so forth, when there's a spike. It's not their fault, it's because there's a spike in the interbank rate. It's these little bits of inside information which are useful for you to know. Okay, bit short on this webinar to tell you that. I think, Simon, we're doing one next week, a 2-hour one, 90-minute one. So I'll go into far more detail on all of these topics in that. If you want an acronym to remember the key elements of successful trading, stop loss, says stop less, apologies, typo, stop loss, volatility based, remember what I said. Entry, multiple indicators, multiple time frames. There's a bit more to it than that because you can nuance it, and in the webinar I'll give you with Simon next week, I'll go into more detail. Limit orders or take profit orders, we don't use them, avoid them, okay, because you're capping your profits, you're asking for trouble. Why would you ever, no professional trader in the history of the world caps his profits if he can avoid it, Trading psychology, when we're using more automation, we're less stressed, we're less worried because we know the machines are looking at the markets for us. Money management, the further away the stop loss, smaller the trade size, additional positions, adding to winners, as I mentioned on the basis that I told you. That's the acronym. Adding to profits, vitally critical. Okay, if there was one thing which I would say is the most important, it is that part, because you've gone to all this trouble of finding a nice, decent, winning trade. For instance, here, why would you then take a profit when you could just keep running it up and up and up? You've done all the hard work. You've done all the hard work, and then you say, oh, thanks very much, I'll go and devote more money to my losing positions. Okay, so I want to give you an insight into the professionals look at it so that you go, oh, wow, thank God somebody told me this. I was making the same mistake all this time and I never realized. Okay, like I said, for me, the background was I perfected my own strategies. They've got a 20-odd year history. That's me at university. Sorry, I look a dick. Red carnation means lost exam. Perfected strategies then. These were then used to win competitions, including in the Financial Times. And when I won that competition, beating one Neil Woodford, by the way. Well, Neil Woodford now manages $10 billion. We only manage, this is embarrassing, less than 100 million euros. Can you believe it? It's who you know, not what you know, clearly, because I know more than Neil bloody Woodford. Am I bitter? Of course I am. And my columns in the FT, Merrill Lynch HSBC paid for the hedge fund because they paid for all this research. And it cost about $1 million to set up a hedge fund. But just so you know that there's a bit of pedigree and history to this. And if you want to see, if any of you know Neil Woodford, if you want to see me smacking him down, there he is, all the way down there. I know his funds are having a bit of problem at the moment. He's good at raising money. He's not good at necessarily turning a profit, not the way I am, when over a 12-month period trounced everybody else. The reason we use automation, and I want you to look more at automation more and more, things like this, which tells us that there's multiple indicators across multiple time frames telling us when to buy and sell, is because without an indicator, this is what 99% of private investors are doing right now. They're picking one trade at a time, they're screen slaves, they're sitting there, they're looking at Elliott, they're looking at MACD, they're looking at RSI, they're looking at all of these things. Now, don't get me wrong. I've been the chief guest at the annual dinner of the Society of Technical Analysts twice, okay? So they respect me, I respect them. For an 18 books, which has a lot about technical analysis. It was great 10 years ago, 20 years ago, 30 years ago. Now, doesn't actually in and of itself work. Neither does gambling before news. Instead, what we're trying to do is, like I said, the methodology that I told you. We're just trying to get into some of those trends based on the odds being in our favor, tiny bit more than against us, and then adding to our winning positions and making sure we don't trade too large a size by decreasing our size the further away the stop loss. With an indicator, it's like this. We've got multiple opportunities. We've got multiple opportunities to examine. I've got this many, plus a whole bunch more, which are not even on the screen, to examine, to monitor. When you can monitor multiple opportunities, you're in a better position to pick one good, decent trade a day. Now, I ain't say, well, Alpesh, surely if I do 1 million trades a day, I make more money. No, it's like an N curve. It's like an upside down U. If you do no trades, you'll make no money. If you do 1 million trades in a day, you won't make any money because your costs will be too great, okay? So logically, what joins those 2 points up? It's a curve. What's the optimal number? In my experience, but you're free to disagree if you wish, roughly for private investors, 1 good quality trade a day, which, by the way, the time frame that we like the most for private investors, even if you've got a day job, is the 1 hour time frame. Why? Because on a 1 hour time frame, you'll get about 1 signal a day. 1 signal a day. If you're looking at 16 or 22 different indicators over a 15-minute period, you're going to have something available you can trade where the price is near the entry. It's not near the entry there. You can go through and find where the price is near the entry and look to get in at that point. So my point being, that gives you ample free time, it gives you ample return on time invested, and there's a lot more mathematics behind it, which we don't need to go into, but ideally we're looking to be in a situation where, and write this down, losses you make should be small in size, short in duration. Any trading strategy should be such that losses are small in size, short in duration, and gains should give you a window of opportunity in which to enter. Look at that. A robust trading system should not have you having to sit at the screen and somebody say, oh, you missed it by 0.1 second, oh, you're out. If we went to our pension funds who invest in us and said, oh, if we were out by 5 seconds on 3 trades, we would have gone from profitable to loss making, they'd say, give us our money back. You're not robust as a strategy. So there should be a window of opportunity in which to enter, which means you've got ample time to look at the screen for 15, 20 minutes before and after work, pick 1 trade where the price is near the entry, okay? And it should be such that it's looking to get you in or out in a clear, systematic way before a trend forms, okay? And any losses would be small in size, short in duration. I'm a brand ambassador for the one and only brokerage which isn't UK, US, Australia regulated. Like I said, I met their CEOs, I met their management team, went to their offices, met their staff, and started using them to make sure that I'm going to rip people off. And what I've got a mission to make more brokers legitimate. And I want actually a certification system for brokers, and I've sent a submission in to the FCA rather, about this. Go to alpeshpatel.com/24 to trade cryptocurrencies as well as Forex and all the rest of it if you wish. More and equally importantly, go to that link I showed you earlier, and on there you'll see an article about trading cryptocurrencies, what I like, what I don't like, what to be careful of, what not to be careful of, and how to do it, because everyone's going crazy over crypto. We've got an ICO initial coin offering coming up because, hey, we like to be at the cutting edge of fintech. But if you go to alpeshpatel.com/webinar special, you'll see there's an article there about trading cryptos, let alone trading all of this. When you do, and if you do, like I said, I'm a brand ambassador there, let them know, hey, we know Alpesh. If you're worried, because like I said, no brokers. I don't trust any brokers. But what I like to do is when I go in and speak to brokers is say, listen, I carry a big stick and a lot of friends and a lot of publicity. So don't mess me about. Okay, it's as simple as that, because I don't trust brokers, any of them. The ones that I do like, and I like these guys because they're really focused on education. They're turning it around as well. What I want you to do, you're going to get a whole bunch of slides and stuff on that link there, alpeshpatel.com/webinar special. I appreciate I've gone through a hell of a lot of stuff in a very, very short space of time. Simon, if there's anything at all you want me to go over again, there must be a load of questions and stuff, let me know and I can do that as well.
Alpesh, that's great. We've just got about 5 or 6 minutes. If we can, okay, how many, first of all, just how many ratios do you consider for long-term investing?
Yeah, so what we look at is, initially we took them all in. Let me tell you, we went through, let me see if I can pull it up. We went through every single piece of data, but what we actually did was we actually went through the academic research. Okay, and we went through, anybody who followed my Diary of an Internet Trader column in the Financial Times will know we went through a whole bunch of academic research going back over 100 years to see what they were saying was relevant, what wasn't over that period of time when it came to stock forecasting over a 12-month period. Okay, so so whilst we looked at all of them, we realized that some of them had next to no weighting. It just didn't matter what they were doing. So actually for valuations, there's only about 3 ratios which have any weighting of any significance. For growth, because there's no point in having an undervalued company because it could be undervalued because it's rubbish. So you want it also to be a growth company, but you don't just want an overvalued growth company because it could crash tomorrow. Okay, and then you want a base below which the valuation won't drop. So you want a company which generates income, because if its price drops, then its dividend yields increase. So in each category for valuation, growth, and income, there's only about 2 or 3 ratios which add any statistically significant weighting. Okay, now I've given you the names of the outputs over here, and then we weighted them and rated them over there. And that's what was the basis of this algo from 2004 for stocks. Okay, and this is the current, as of today, 12:50 p.m. 24th of August, the equities for the next 12 months we really like. And personally, if you were to buy those top 10, and I know some of them are in the same sector, people go, wait a minute, Bellway and Taylor Wimpey, highly correlated, Persimmon, stuck in there as well. Actually, what we've realized is I'd rather divide my money in half or in thirds between 3 companies in the same sector than only have 1 company with all of the money in the same sector, if you see what I mean. So you can still diversify away, but we do take a bottom-up approach.
Thank you, Alpesh. Will's asking, what are the settings for MACD and MACD2? Is this something you can do now, or is this maybe something for the webinar next week?
Couple of issues there, Will. No one indicator works, okay? Because no one particular thing works, what we realized is that whatever statistical data you look for on any particular indicator, okay, and say, oh, should it be 12 or should it be 14 or should it be 14.1, you ended up just curve fitting. Right? So we look at multiple indicators, and in one sense, it doesn't matter what your settings are. The reason is this: when you filter across multiple indicators and multiple timeframes, what's going to happen is, go back to those numbers I told you. A coin is right 50-50. God is right 100% of the time. You're only looking to increase your edge 6 times out of 10. Whether you do that with my settings or yours, as long as you're triple, quadruple filtering multiple indicators, multiple timeframes, it won't actually matter what the settings are, because across any settings, they're always sometimes correct, sometimes wrong. It's the filtration which is important. It is not that there's a holy grail number. It is the multiple observations which is far more important. Now, you might say, well, wait a minute, doesn't that mean you're going to miss some amazing trades? Yes, because the practical person doesn't mind missing great trades as long as they're profitable. The academic is too busy trying to get the top of the market or the bottom. You know, somebody's doesn't know what they're talking about if they ever say to you, see how we got the bottom of the market there and the exact top there. You know they're not what they're talking about. You know they don't know what they're talking about when they start saying, oh, we're right more than 70% of the time. Because if they were, they're better than Warren Buffett. They're better than, on the hedge fund industry, George Soros, David Harding, Bill Lipschutz, all my mentors. And like I said, George Soros. I'm going to go by the people who manage billions, who I aspire to be like, than the academic, who I don't aspire to be like.
Thanks, Alpesh. Kanti says, once you hit the buy-sell set stop loss on the target, if you miss the start and if it is near or reached the target, do you wait for the next buy and sell signal or continue?
Yeah, I think I know what you mean. If you've missed the entry point, let's say, here's a good one. Okay. Look, let's look at this one. Short Australian dollar, US dollar. Let's say you missed that because it was, I don't know, 3 in the morning and you were sleeping. You can see the price is still near there. So I wouldn't have a problem getting in there because I can see the entry price is still very close to entry compared to where I'm going to be adding to a winner and adding even more to it. Okay, so that's not a problem. If it's on the wrong side of it, so it's up here, then I'm not looking to get in because I'd rather it wait and go past through the entry point. If it's too far away, then hey, guess what? I've got a bunch more trades. In other words, be pragmatic. Say to yourself, hey, I missed that one. Doesn't matter. Let's go to the next one. Okay? Oh, I missed that one. Let's go to the next one. Visa, you've missed. okay? Because look, our current signal is all the way down here, 18th of July, and I don't know, maybe it's about to go into a sell. So I don't want to go into doing a Visa trade. It's gone. It doesn't matter because I've got a choice of all these. Plus, even better, I've got a choice of all of these. Look at that, okay? There's an ample world of opportunity out there. You see, we picked a trading strategy which could work based on trading psychology, which is following trends using that fundamental trading psychology, which is true whether somebody is trading looking at one-day prices or 5-minute prices. So that allowed us the greatest flexibility. I'll give you an example. Let's look at, let's put this one on Euro Sterling because everybody's talking about it. This is the 4-hour, okay? Let's say we go to 5-minute. I don't recommend 5-minute because you'll make smaller profits and have to work harder for them because you'll have to do more trades to make the same money. Okay, that's the entry signal over there. What I'm saying is the psychology of trend following is the same whether it's 5-minute or 4-hour. Some people are trading 4-hour and they're moving that market and others are trading 5-minute. So we wanted a system which gave us the maximum opportunities. Guess what the secret of success in life is? Having the most opportunities open to you, but then picking only one or two. Not trying to chase all of them. Well, you don't need a degree in rocket science to tell you that. You certainly don't need to learn that from trading. But why would the secrets of success that appeal in other areas of life not also be relevant for trading? Of course they are.
Thanks, Alpesh. Richard says, does Alpesh get into trades on breakouts at the market or with limit orders? Taking trades with the algo systems if their signals come into being in arrears to price passing through a certain trigger level, it will be taking the trades at market price in most instances. Would you agree with that?
I think I know what they mean.
Yeah.
Let's say you're looking at, where was it? Was it the Facebook one? Okay, let's say you're looking at Facebook. The reason I say, or actually, let's say you're looking at all of these. The reason I say you're going to look at the screen for 15 minutes is because when you look at these over a 15-minute period, one of them, not all of them, one of them is going to be most probably statistically, because there's 24 hours in a day, and given the number of products you're looking at, one of them will have an entry level near the price point. Okay, when that happens, and by the way, they're not all going to be winning trades. Only 6 out of 10, but our profitability from our adding to our winning positions. So let's say we get a price near the entry, then you can place the entry straight away with the broker. You can place your additional entry because you know where it is because it's based on volatility. At the same time, you can say to the broker, if the price goes to this level, buy, and put its stop loss there. Okay, why is it there? Well, because of the volatility, right? I'll go more into this at the full-blown webinar. What that allows us to do is place the entry level at the time we see it, place the next order without us having to watch the market, place its trailing stop, which will only be executed if the entry level is executed, and let's say the additional position wasn't triggered, doesn't matter, because if only this one was triggered and the market reversed, well, it will be exited at its trailing stop loss, either because the market went straight down or because it went into profit and then reversed a bit. So either way, I can afford to leave the screen, or rather have one of our traders. I mean, look, having people to watch a screen is not a big deal. You can hire 20-somethings to do that, which is what most funds do. 90% of our time is raising capital from pension funds, sovereign wealth funds, growing and scaling up the company. So the surprising thing, like with most things in most businesses, is the one thing that you were doing which built the business, which was trading, ends up being the thing that you end up having other people do whilst you go build the company. So anyway, so we raise capital probably 90% of the time. The traders are the ones who will sit there in front of the screen, follow the signals, and what they'll do, and they're just following simple processes. Like every single one of you who's in a job, you've got simple processes. Your bosses who don't trust you have put you down with, which will be, right, when the price is near the entry, buy, put the, or in this case, sell, go short, put the sell order to sell more at that dotted line with its stop loss here. So you can just put the order when it comes up because you're watching it. And in this case, look at this. This was from 10th of August till now. It's still near the entry. So you could still enter this even though the original signal came on the 10th of August because the price is still near entry.
Okay, sorry, I'm looking at these questions. Richard, I hope that addresses the comments. Sanj was saying, can you get stocks on MT4?
Yeah, oh, right. Great point I want to make to you. You use MT4. I tell private investors to use MT4 to monitor the market. Look, all trading is two things. One is monitoring and one is placing a trade. Trade with any broker you want. Don't trade using MT4 because I think it's an ugly, complicated platform. Instead, monitor the market with MT4 because it's free, live, real-time software. That way you don't need to pay a fortune for a Bloomberg terminal or a I don't know, Ninja Trader or whatever else software is out there. All of these are free, live, real-time prices, free, live, real-time prices for life. So you can monitor the market here, but you can place a trade using any broker you want because the prices I showed earlier in one of the slides are relatively similar. And you want a broker which is easy to trade on. Okay, so what I recommend most private investors do as a matter of practicality is on their laptop or PC, they look at the screen that you're seeing now, and on their cell phone, they place the trade. Why? Well, first of all, it means that they've got two screens all of a sudden without having to pay any money because everyone's got a cell phone. And the brokers' apps on cell phones, which are invariably free, are always easier to use when it comes to placing a trade, I think, than something as complicated as MT4. I think MT4 is ugly. Okay, I just think it's ugly. Okay, so you're using it only to monitor the market, not for trading. I hope that makes sense, and it often confuses people because they feel obliged to place the trade from what they see on screen. You don't have to do that. The prices across brokers are all linked to the interbank rate. They're all very similar, and we've actually done an experiment on this where we've placed trades with one broker even though we got a signal from a different data feed from a different broker, and what we discovered is it made next to no difference to our profitability. We did that as an internal exercise just to see what if brokers are playing games and so on and so forth, if they're monitoring trades, if they're trying to screw us and whatever else. And actually, a surprising fact was it made next to no difference if we got our data from one broker on MT4 and placed the trades to another broker. It was amazing.
Okay. Well, Alpesh, thank you very much. That's just over a full hour you've given us, so much appreciated. I know it's been a hectic day and you've squeezed us in, so that is superb. I know we're going to have you back next week for the full-sized webinar. That's just been a little sort of update, and we appreciate that. So thank you very much indeed, Alpesh Patel. And keep tuned, and we'll send you details of Alpesh's big event next week that we can attend. Okay, so take care of yourself, Alpesh. I will.
Thanks, Simon. Thanks, everyone.
Thank you again. Bye bye.
Thanks. Bye.